How do interest rates affect the entire economy? Imagine a world where borrowing money suddenly becomes more expensive or cheaper overnight. That's what changes in interest rates can do to the whole economy. When central banks decide to raise or lower interest rates, it sets off a chain reaction that touches everything from your daily spending to big business investments. Higher interest rates mean borrowing costs go up. If you want to buy a house or a commercial property, your mortgage payments or loan payments will be larger. This can make buying or refinancing a property less attractive, slowing down real estate sales and development projects. For investors, higher rates mean higher cap rates, which are used to value income-generating properties. When cap rates go up, property values tend to go down because investors want a bigger return for their risk. That can lead to a dip in real estate prices overall. On the flip side, when interest rates fall, borrowing becomes cheaper. Homebuyers and real estate developers can get loans at lower costs, which often boosts demand for properties. More demand can push property prices higher and encourage new construction. Lower rates also make real estate investments more appealing compared to bonds or savings accounts, which now offer lower returns. This increased demand can drive up property prices and make real estate a more attractive investment. Interest rates also influence how much people want to rent versus buy. When mortgage rates rise, fewer people can afford to buy homes, so more turn to renting. This can cause rents to go up, especially in markets with limited new supply. For landlords, higher rents can help offset the increased costs of financing their properties. Beyond real estate, interest rates impact the entire economy. When rates go up, borrowing costs for consumers and businesses increase. This can slow down spending and investment, leading to slower economic growth. Conversely, lower interest rates encourage borrowing and spending, which can boost economic activity and employment. For real estate investors, keeping an eye on interest rate trends is key. Locking in fixed-rate loans can protect against rising costs. When rates are expected to go up, it might be better to buy sooner rather than later. Also, understanding how cap rates and property values react to interest rate changes helps in making smarter investment choices. In the end, interest rates act like a big economic thermostat. They influence how much money flows into real estate, how much it costs to finance properties, and how the overall economy grows or slows down. Knowing how these rates move and what they mean for borrowing and investing can help you make better decisions in the world of real estate finance.